Welcome back to another video. Sohail here, and today I want to explain RSI2 strategy and how you can use it for trading. RSI2 strategy is developed by Larry Connors, and it's a very simple strategy for entering a trade in the direction of trends. Please pay attention that using RSI in this strategy doesn't mean that this strategy is designed for identifying top or bottom of prices and possible reversals. RSI2 strategy is used for entering in the direction of trends in the pullbacks during price correction period. It's actually a short-term strategy to step in an ongoing trends. In other words, to participate in an existing trend. First, we must identify the major trend of the market, and Larry Connors suggested using moving average with length of 200. Actually, he recommended working on one-day chart and having a 200-day moving average. This strategy can be adapted to shorter time frames simply by adjusting the length of moving average. So by the help of this 200-day moving average, we can identify long-term trend. When the price is above this 200-day moving average line, the long-term trend is up, and when the price is below this 200-day moving average line, the long-term trend is down. So here in this strategy, when the price is above moving average line, we must look for buying opportunities because the direction of the major trend is up and we want to enter in the direction of this uptrend. And when the price is below moving average line, we must look for selling opportunities because the direction of the major trend is down and we want to enter in the direction of this downtrend. And next, we must add RSI indicator to the chart. Here in this strategy, we don't use RSI the way it's generally used, and we use it for entering in the direction of trends, not identifying reversals, which is the main usage of RSI. If you're not familiar with RSI, I have a video that I completely explain RSI and you can watch it later. Here in this strategy, we set the length of RSI to 2. So we have 2-period RSI on our chart. And also we must adjust RSI levels to 10 and 90. Actually, in this strategy, the RSI level between 0 and 10, which is considered deeply oversold, is for buying, and RSI level between 90 and 100, which is considered deeply overbought, is for selling. Larry Connell tested this strategy in hundreds of thousands of trades, and he found that when RSI goes below 5, the return on buying was higher in compared to when RSI goes below 10. In other words, in this strategy, the deeper the RSI goes oversold, the possibility of gaining higher return is higher in long positions. And similarly, when RSI goes above 95, the return on selling was higher in compare when RSI goes above 90, which means the deeper the RSI goes overbought, the possibility of gaining higher return is higher in short positions. Considering zones above 95 or below 5 may provide you less signals and you may miss some good movements, but you will have better and more reliable signals. And considering zones above 90 and below 10 provide you more signals and catching more movements, but also more false signals. So the choice of the RSI level is up to you. If you are a conservative trader and you want to take less risk in trading, you can choose 5 and 95 levels. And if you are a more aggressive trader, you can choose 10 and 90 levels of RSI. Based on this strategy, when the price is above moving average line, which means the major trend is up, and also when the RSI line is below 10, which means deeply oversold, it gives us buying signal and we have the opportunity to enter in the direction of the uptrend, because based on this strategy, we have signs that the pullback is ending and the price is gonna advance. And when the price is below the moving average line, which means the major trend is down, and also the RSI line is above 90, which means deeply overbought, it gives us selling signal. And we have the opportunity to enter in the direction of the downtrend, because based on this strategy, we have signs that the pullback is ending and the price is gonna fall. Larry Connors suggested before the close entry, and he thinks when the RSI level is deeply overbought or oversold, it's enough to enter. But pay attention that waiting for the close gives us more flexibility to decrease the risk and increase the winning rate. So by waiting for the close, we can improve our entry level. In technical analysis, we generally wait for the close, and actually closing of candles are part of the analysis, so it's better to wait for the close. And for take profit orders, he suggested the exit points based on 5-day simple moving average. Actually, when you go long, you exit and you take your profit when the price moves above the 5-day simple moving average. And when you go short, you take your profit when the price moves below 5-day simple moving average. This is a short-term strategy with quick exit, and this is what Larry Connell advocated. But you may decide to stay longer in the cases that a strong move takes hold. And also, Larry Connell doesn't advocate stop loss, and he thinks that stop loss can damage the performance of the strategy. But I think it's not a good choice, and setting a stop loss is necessary to manage the risk. You can set your stop loss by analyzing the price action, and also you can use ATR multiples for setting trailing stop loss so that you can lock in your profit step by step, so you will be in the position as long as that the price is moving in the expected way. By doing this, you don't just exit your position quickly when the price crosses 5-day SMA, and you will be in position in the cases that a strong move takes hold. If you are not familiar with ATR indicator and you're interested to learn how to use it to measure volatility and to set trailing stop loss by the help of ATR multiples, I have a video that I completely explain this indicator, and I recommend you to watch it later to learn this useful indicator. Please pay attention that the signal that you get from RSI2 strategy is a kind of early signal, and the price may continue higher when RSI goes above 95, or it may continue lower when the price goes below 5, or especially the time that the long-term trend is turning the other way, we may get false signals. So you must consider other aspects of technical analysis for confirming the signal that you get from RSI2 strategy: volume, candlestick patterns, indicators, oscillators, and other concepts of technical analysis can help you on this. You can also analyze lower time frames, I mean intraday charts, to find clues that confirm your signal. Alongside with these, we can also use the RSI2 itself to filter the false signals by waiting for the RSI line to come back above or below the center line. For example, when RSI2 is below 10, we can wait until the RSI crosses center line and moves above that, or when the RSI is above 90, we can wait until the RSI crosses center line and moves below the center line. RSI2 strategy is an aggressive short-term strategy designed to enter a trade in the direction of trends and taking a quick profit and exiting. The original setting is suitable for swing traders, and by using this strategy in lower time frames and adjusting the length of the moving average, you can effectively use this strategy for day trading. If you're not familiar with moving averages and proper settings and adjusting for different kinds of trading, I have a video on this that is a complete guide to moving averages, and I recommend you to watch it because moving averages are one of the important indicators that you must know how to correctly use it. Thank you for watching this video, and I hope it has been helpful for you. If you have any question, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you found any value in this video, please like it, please subscribe to my channel if you haven't already, and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.